Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the month gone by. We will also share our views on the domestic fixed income markets, which could, in turn, impact the positioning of our schemes. 10-year benchmark United States Treasury and benchmark yields of 10-year German Bund hardened by 40 basis point and 28 basis point during the month of December 2024, whereas 10-year Japan bond hardened by 4 basis point during the month. United States U.S. Federal Reserve delivered a hawkish rate cut of 25 basis point in December 2024. Previous guidance on rate cut cycle was of 100 basis point, September 2024, which revised as per December 2024 dot plot to 50 basis point. Donald Trump's U.S. election victory spurred surge in dollar. The grim outlook for bonds in the new year, a slower rate cut cycle by U.S. Federal Open Market Committee and U.S. President-elect Donald Trump's likely inflationary policies pushed benchmark Treasury yields to 4.58 levels, a jump of 40 basis points over November 2024. Inflation, though, has softened from peak of rate hike cycle. The disinflation process has been stalling, as could be witnessed from November 2024 print at 2.7% year-on-year vis-à-vis 2.6% year-on-year in October 2024. The labor market has been showing diverging trends across parameters, but showing signs of coming to better balance, with demand improving at the margin as supply easing. The unemployment rate in November 2024 printed 4.2%. The U.S. Treasury yields increased across 10-year and 30-year yields, moving up by around 40 basis point each, whereas 2-year U.S. Treasury moved up by only 9 basis point, thus increasing the 2-year and 10-year spread to 32 basis points vis-à-vis 2 basis points in November 2024. Bank of England kept its interest rates at 4.75% in December 2024, adopting a gradual approach to removing the monetary policy restraint. This is as inflation in United Kingdom has drifted upwards and shows persistence, and growth expectations are higher, around 1.7% in 2024 and 2025. European Central Bank decided to cut interest rates by 25 basis point in its December 2024 policy, reiterating that Governing Council is not pre-committing to a particular path, as growth is expected to be slower than anticipated earlier, whereas inflation is expected to moderate to 2.1% in 2025 from currently 2.4%. Bank of Canada lowered the policy rate by 50 basis points to 3.25%. as inflation has been near to its 2% target and growth has been softer, as economy is expected to grow at 1.2% in 2024. Japan. In December 2024, Bank of Japan kept its interest rates unchanged at 0.25%, though inflation expectations for 2024 is 2.5% and 1.9% in 2025. This persistently high inflation and continuous depreciation of Japanese yen can increase the odds of Bank of Japan increasing the interest rates further, and needs to be closely watched. The monetary policy divergence of US and Japan will be a key risk for global markets. Japan is one of the largest holders of US Treasury yields, and the interplay between US dollar per Japanese yen, 10-year Japan benchmark and 10-year U.S. Treasury yields continues to provide uncertainty on global rates. 10-year Japan government bonds have hardened by 4 basis point and closed above 1% at 1.09% in December 2024. Yen averagely was at 154 levels in the month of December 2024 and closed at 157 levels as on December 31, 2024. The 10-year GSEC traded in a band of 6.68% to 6.79% and closed at 6.76% in December 2024, vis-à-vis 6.74% in November 2024. At primary auctions, yields of 91-day T-bill hardened by 6 basis points, whereas yields on 182-day T-bill and 364-day T-bill hardened by approximately 4 basis points each. In December 2024 policy, Reserve Bank of India kept its policy rate unchanged at 6.5%, revising its inflation projection upwards to 4.8% from 4.5% for FY 2025 and growth expectations for FY 2025 from 7.2% to 6.8%. Indian benchmark bond yields increased by 2 basis points during the month. Following the hawkish Federal Open Market Committee policy, Indian rupee closing at its historical low of 85.62 levels and tight system liquidity for the month of December 2024, 10-year Indian government bonds drifted higher to intermittently reach 6.79% levels. Public sector banks have been seen as buyers at 6.79% levels in addition to foreign portfolio investments buying to the tune of 3,500 crores for the month of December 2024, causing the benchmark yields to close around 6.76% levels. CPI inflation stood at 5.48% in November 2024, lower than 6.21% recorded in October 2024. Food and beverages inflation moderated to 8.20% in November 2024 from 9.69% in October 2024, led by a fall in prices of vegetables, pulses and products, fruits and cereals and products. In November 2024, the CPI excluding food and beverages stood below 4.0% at 2.95%. For the 15th consecutive month. Core inflation stood 3.64% in November 2024, marginally changed from 3.67% in October 2024. Inflation scenario continues to remain uncertain with persistent price pressures from the food basket. The RBI has revised inflation projection for FY 2025 higher to 4.8%. From 4.5% earlier. As per RBI projection, CPI inflation is expected to reach the target of 4.0% only by Q2 fiscal year 2026. During the last month of 2024, USD portrayed continued strength and appreciated by 2.37%. Since Donald Trump's victory in the U.S. presidential elections, USD has shown greater strength over all the key global economies. During 2024, dollar index appreciated by 7.06% compared to a depreciation of 2.11% in the previous year. While USD appreciated during the month, all the key currencies noted a depreciation. US and Japan have been on the opposite sides of the monetary policies, keeping the global currency market volatile. Japan is expected to raise interest rates further in the coming months in view to curb inflation and to support Japanese yen from depreciating further. Indian rupee depreciated by 1.31% in December 2024, despite foreign portfolio investments turning net buyers after 2 months. Indian rupee traded in the range of rupees 84.69 to 85.61 per US dollar during the month and ended the month at rupees 85.61 per US dollar. FPIs were net buyers in both equity and debt markets in December 2024, with inflows of rupees 15,446 crore and rupees 3,755 crore, respectively. Due to excessive pressure on Indian rupee, forex reserves have been on a declining trend. Forex reserves stood at US $644.4 billion as on December 20th, 2024 compared to US $656.6 billion a month ago, noting a decline of US $12.2 billion during the month. Liquidity conditions during December 2024 continued to remain tight, despite the RBI releasing liquidity amounting to rupees 1.16 lakh crore through credit reserve ratio cut of 50 basis point in 2 tranches of 25 basis point on December 14, 2024 and December 28, 2024, systemic liquidity remained in deficit. Banking system noted a daily average deficit of rupees 64,769 crore in December 2024 compared to a daily average surplus of rupees 1,41,548 crore in November 2024. The daily average of weighted average call rate stood at 6.65%, higher than the November's average of 6.53%. Bank deposit growth stood at 11.5% as on December 15, 2024, same as the credit growth. On a fiscal year-to-date basis, bank credit has grown by 7.0% compared to a deposit growth of 7.8% in the same period. Momentum in credit growth has slowed, largely led by moderation in personal loans and bank credit to non-banking financial companies. The economic indicators continue to show a mixed picture, especially with strong indicators such as robust GDP and retail spending. The Trump administration to bring inflationary policies. On the other hand, inflation seems to be on a sluggish downward trajectory. Key monitorable remains from developments in China as well as Japan over the medium term. China would be expected to have support both from monetary but more importantly fiscal side to get its house back on track. The resultant impact on commodity cycle upturn may be a development to be watchful of, especially for import-dependent nations like India. Japan, on the other hand, shall be on a rate hike journey, and the resultant impact of unwinding of yen carry trades on various asset classes could be another important monitorable. While domestic inflation is susceptible to volatility due to food components and certain high-frequency indicators in the past few months have shown some signs of moderation, GDP growth printed substantially lower than market consensus. Foreign capital movement away from Indian markets, equity and debt, and to better valued China markets and stronger dollar index have kept the Indian rupee under pressure. FPIs were net buyers in the domestic debt markets in December 2024 after being sellers for past 2 months. Nonetheless, Indian government bonds inclusion in the third global index would help keep the demand-supply dynamics favorable. Also, the new liquidity coverage ratio norms by the RBI could keep the demand side of the equation well supported. Also, the government's intent to be fiscally prudent could act as one of the key positives for the domestic bond market. The government aims to bring down fiscal deficit below 4.6% by FY 2026.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.